a catastrophic net loss of $11.03 billion. Yet Intel is quietly generating billions in underlying cash. Does this alarming headline mean the tech giant is completely broken, or is there a hidden fundamental value that Wall Street analysts are entirely ignoring today? When you look at the diluted earnings per share of negative $2.16, the initial reaction from the market is usually pure panic. Financial headlines constantly scream about a structurally broken business model. But when you dig deeply into the operating cash flow of $8.1 billion, you quickly realize this is a massive structural advantage. Management took a $12.53 billion non-cash derivative loss tied to escrowed shares, meaning they are penalized on paper simply because their stock price went up. This disconnect between the headline and the actual operating cash flow reveals the core business is highly generative, despite that staggering $11.03 billion GAAP net loss. The firm is printing money while the income statement looks like an absolute disaster. To truly grasp why this cash engine is humming, look at how gross margin reached 40.4%, representing a massive leap from 27.5% a year ago. Most analysts assume legacy hardware companies are just racing to the bottom on price to maintain market share. However, data center and artificial intelligence segment revenue hit $6.26 billion, driven by a staggering 48% increase in average selling prices. The company is successfully passing along higher input costs for heavy physical infrastructure, like massive server racks and sprawling server farms. The operating margin followed suit, successfully climbing to 11.1% after falling to negative 24.7% last year. This premium pricing power proves the business is not just another basic commodity hardware vendor struggling to survive. This brings us to the real elephant in the room regarding liquidity. Free cash flow swung to a positive $1.91 billion, recovering remarkably from a $5.87 billion free cash flow burn in the prior year. The crowd is purely focused on top-line vanity metrics and completely misses this crucial financial cushion. Intel is funneling this internally generated cash into physical realities, deploying capital expenditures of $6.19 billion to build out real-world fabrication plants. Management is currently deploying €5 billion in capital investments for a European manufacturing expansion, aiming to securely localize supply chains with hard physical assets. Building these leading-edge fabrication sites takes immense capital, and internally funding it protects the firm from borrowing heavily at the current federal funds rate of 3.5% to 3.75%. Yet, not every segment is printing cash, creating a critical strategic tension. The foundry segment reported an operating loss of $2.09 billion. Wall Street is completely captivated by these immediate profit drags, viewing the internal manufacturing pivot as a highly dangerous money pit. But you have to look at the physical progress, like the successful completion of the Secure Enclave program for domestic microelectronics. The company is taking a deliberate profitability hit today to establish absolute domestic leadership in secure hardware manufacturing tomorrow. While casual observers focus on that $2.09 billion immediate operating loss, the true driver of this valuation is securing a localized supply chain moat. This leads to an incredibly aggressive balance sheet move where management deployed $14.2 billion in cash to completely buy out a minority joint venture interest in an Ireland facility. At first glance, this strategy seems reckless, especially as the debt-to-equity ratio worsened to 0.58 times from 0.41 times just 6 months ago. The business is intentionally trading near-term balance sheet leverage for long-term operational autonomy over its physical infrastructure, knowing its total assets still stand at a massive $202.44 billion. By eliminating future profit-sharing obligations on these European fabrication plants, Intel reclaims absolute control over its global manufacturing footprint. This high-conviction restructuring play ensures that when these physical factories hit peak production, every single dollar of profit flows straight back to the firm. To understand the limits of this turnaround, we must confront a fundamental physical barrier affecting the entire industry. Total revenue grew by 25.4% year over year, reaching $16.13 billion. Pundits assume this growth is solely bound by how many chips end users actually want for everyday consumer hardware like standard laptops and desktop computers, but the fundamental reality is that market demand is far exceeding available product supply. This massive backlog proves their products are deeply essential, yet the company hits a physical growth ceiling due to internal factory constraints and industry-wide component shortages. These material bottlenecks are projected to persist well into the future, creating an artificial speed limit on successfully scaling operations. This constraint illuminates the final piece of the strategic puzzle hidden in the assets. While data center revenue surged incredibly fast, the firm recognized a brutal goodwill impairment of $3.9 billion in its automotive unit. Many retail traders view this massive $3.9 billion write-down as a definitive sign of broader technological failure. But look at where management is steering the ship to capture future value. They are partnering with new tech firms for advanced glass packaging to power the next generation of data center hardware, while ruthlessly marking down peripheral bets. This duality highlights a clear strategic imperative. The business simultaneously reduced operating expenses to $4.5 billion, rapidly accelerating its core artificial intelligence infrastructure while pragmatically stripping away useless dead weight. This allocation strategy is exactly what you want from a mature technology giant navigating an industry shift. So we return to our opening question. Is that terrifying $11.03 billion GAAP net loss a sign of terminal decline or an illusion masking a resurgent giant? The truth is clearly the latter. Intel is executing a profound transition, shedding peripheral businesses and taking deliberate margin hits to reclaim its global manufacturing crown. Generating an impressive $8.1 billion operating cash flow proves the core engine is healthy, even despite disastrous paper derivative losses. When you strip away the market noise and look strictly at the fundamental cash generation, the picture changes entirely. The idea of a failing hardware dinosaur is fundamentally flawed when you actually read the balance sheet. For the intelligent investor, the current valuation does not look like a value trap, but a long-term compounding machine temporarily obscured by accounting noise and physical supply constraints. By recognizing the profound pricing power currently pushing gross margin to 40.4%, you can immediately see a margin of safety built on real cash flow and hard physical assets. The transition will require immense patience, but the fundamental groundwork for the next decade of domestic semiconductor dominance is already firmly in place. I want to hear your take on whether this massive foundry pivot will pay off or if the capital drain is too risky in this environment. Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.